A war involving Iran would not stay confined to the Middle East. It would ripple through global markets, disrupt energy supply chains, and push fragile economies closer to crisis within days. This is not just about geopolitics or regional conflict. It is about oil prices, inflation, supply chains, and the financial stability of economies already under pressure worldwide. Modern economies are tightly interconnected, meaning a shock in one region quickly spreads across continents. A conflict in Iran could trigger consequences far beyond the battlefield itself. Energy markets would react immediately, and financial systems would follow. Investors do not wait for outcomes. They respond to risk, and war introduces uncertainty at a global scale. The question is not whether the world would feel the impact, but how severe that impact would be. In many scenarios, the consequences could resemble the early stages of a global recession. To understand why, we need to look at Iran's position in the global energy system and how conflict could disrupt the flow of resources that modern economies depend on. Iran sits at the center of one of the most strategically important regions in the world for energy production. It borders the Persian Gulf, a critical hub for global oil exports. The country itself is a major oil producer, but its importance extends far beyond its own output. Its geographic position gives it influence over regional shipping routes and supply flows. Nearby countries such as Saudi Arabia, Iraq, Kuwait, and the United Arab Emirates also rely on this region to export massive volumes of oil to global markets every day. All of these exports pass through narrow maritime corridors, especially the Strait of Hormuz, making the region both efficient and extremely vulnerable to disruption. For decades, tensions involving Iran have created periodic instability, but large-scale conflict has been avoided. That balance, however, is fragile and constantly under strain. At the same time, the global economy is already facing challenges, including high inflation, rising interest rates, and slowing growth in major markets. This means the system is not entering such a conflict from a position of strength. Instead, it is already weakened, making it far more sensitive to external shocks. In this environment, even a limited conflict could trigger reactions that extend far beyond the immediate region, affecting economies worldwide in complex ways. To see how this happens, we need to break down the mechanisms through which a war involving Iran could cascade into a global economic crisis. The first and most immediate impact would be on oil supply. Any conflict involving Iran risks disrupting production, transportation, or both simultaneously. Markets respond not only to actual supply disruptions, but also to the expectation of disruption. Even the threat of reduced supply can drive prices sharply higher. Oil prices are highly sensitive because global demand remains strong while spare production capacity is limited. This creates a tight balance that can be easily disturbed. If conflict escalates, shipping routes may become unsafe, forcing tankers to delay or reroute. This slows the flow of oil even if production itself remains unchanged. Insurance costs for shipping would rise significantly in a conflict zone. Higher costs translate directly into higher prices for transported energy resources. At the same time, countries may begin stockpiling oil in anticipation of shortages. This behavior increases demand artificially and further drives up prices. Financial markets amplify these movements through speculation. Traders react quickly to geopolitical developments, often pushing prices beyond fundamental levels. As oil prices rise, the cost of fuel increases globally. This affects transportation, logistics, and manufacturing, all of which rely heavily on energy inputs. Higher fuel costs mean higher costs for moving goods across supply chains. This increases the price of everything from raw materials to finished consumer products. Electricity generation in many regions also depends on fossil fuels. Rising energy costs therefore impact not just transport, but entire power systems. Industries that are energy-intensive, such as manufacturing, chemicals, and construction, face immediate cost pressures that reduce output and profitability. Small disruptions can be absorbed, but sustained increases in energy costs create structural pressure across entire economies, reducing efficiency and growth. At the same time, governments may intervene through subsidies or price controls, which can strain public finances and increase fiscal deficits. Currencies of energy-importing countries may weaken as they spend more on imports. This further increases inflation and reduces purchasing power domestically. All of these effects combine into a broader economic slowdown, driven initially by energy, but spreading into multiple sectors simultaneously. In this way, a regional conflict begins to transform into a global economic issue through interconnected systems that depend on stable energy flows. One of the first visible effects would be inflation. As energy costs rise, prices increase across transportation, food, and basic consumer goods. Higher inflation forces central banks to respond, often by raising interest rates. This makes borrowing more expensive for businesses and consumers alike. When borrowing costs rise, investment slows. Companies delay expansion, reduce hiring, and focus on maintaining cash flow rather than growth. Consumers also reduce spending as living costs increase. This leads to lower demand across sectors, further slowing economic activity. Airlines, logistics firms, and shipping companies would be among the hardest hit. Fuel is a major cost component, and price spikes directly impact profitability. Supply chains, already strained in recent years, would face additional pressure. Delays, higher costs, and uncertainty would reduce efficiency further. Food prices could also rise, as agriculture depends heavily on fuel for production, processing, and transportation across global markets. Developing economies would be particularly vulnerable. Many rely heavily on imported energy and have limited financial capacity to absorb shocks. Currency depreciation in these countries could accelerate inflation, creating a feedback loop that destabilizes local economies. Financial markets would react to rising uncertainty. Investors typically move capital into safer assets, causing volatility in stocks and emerging markets. Stock markets could decline as expectations for corporate earnings weaken. This reduces wealth and confidence among investors and consumers. Banking systems may also face stress if economic conditions deteriorate. Loan defaults could increase, especially in sectors exposed to energy costs. Governments might respond with emergency measures, including subsidies or stimulus spending. While necessary, these actions can increase national debt. In advanced economies, the impact may be less immediate, but still significant. Higher prices and slower growth would reduce economic momentum. In extreme scenarios, these combined effects could push the global economy into recession. This would not be caused by one factor alone, but by cascading pressures. The interconnected nature of modern economies means that no country is fully insulated. Even those less dependent on Middle Eastern oil would feel indirect effects. Trade flows would slow as demand weakens and costs rise. This reduces global economic activity and reinforces the downward cycle. Confidence, which plays a crucial role in economic stability, would be shaken. Uncertainty often leads to cautious behavior, further slowing growth. In this way, a war involving Iran could evolve from a regional conflict into a global economic event with wide-reaching consequences. The risk is not just about war itself, but about how modern systems respond to disruption. Energy, finance, and trade are deeply interconnected. A conflict involving Iran sits at a critical junction of these systems, making its potential impact disproportionately large compared to its geographic scope. What begins as a regional crisis could quickly become a global economic challenge, affecting everything from fuel prices to employment levels. The world economy today is more efficient, but also more fragile. Efficiency often comes at the cost of resilience, making systems vulnerable to shocks. Understanding these risks is essential, not just for policymakers, but for individuals whose daily lives are shaped by these global forces. If such a conflict occurs, the effects would not remain distant or abstract. They would be felt in everyday costs, economic opportunities, and financial stability. If you found this analysis useful and want more clear breakdowns of global events, consider subscribing to the channel. It helps support the work and allows more content like this to be produced.